When the market falls sharply, many investors ask the same urgent questions. Should I sell? Should I buy more? Or should I wait? But for most people, the deeper issue is not a missing technical indicator. The deeper issue is that the funding plan was never written down before stress arrived. A red screen makes the brain search for immediate relief. A plan gives the brain a rule to follow. This video is not a market call, and it is not a buy or sell instruction. It is a planning checklist for the next sell-off. When is the money needed? How much volatility is acceptable? What allocation was intended? And what rule applies before emotion takes over? It does not remove turbulence. It tells you which turbulence was already part of the route, and which turbulence means the route itself needs repair. A sell-off tends to reveal three hidden weaknesses. First, money that is needed soon may be exposed to too much volatility. Second, the portfolio may be too concentrated in one asset, one theme, or one decision. Third, there may be no pre-written rule, so every price move feels like a new command. When those three weaknesses appear together, a strategy problem becomes an emotional problem. The goal is not to guess the bottom. The goal is to know which risk you agreed to take before the storm started. Many investors discover during a decline that the real pressure is not the chart. It is rent, income uncertainty, debt, family responsibility, and the absence of a written rule. The first planning step is to separate money by purpose and time horizon. Money needed soon for rent, tuition, medical bills, taxes, or living expenses usually has less ability to tolerate large market swings. Medium-term goal money should be matched to the goal date and the flexibility of that goal. Long-term capital may tolerate volatility, but not unlimited volatility. It still has to fit income stability, debt, family responsibilities, and emotional tolerance. Once the use date is clear, a market decline no longer turns every dollar into the same panic question. Instead of asking whether your entire life plan should change because prices change today, you ask separate questions. Are near-term bills safe? Does a medium-term goal need adjustment? And is long-term capital still within the risk range you accepted? An emergency reserve is not only about being conservative, it protects decision quality. If basic living expenses are covered for a period of time, an investor is less likely to be forced to sell long-term assets during the most stressful part of the market. The reserve does not prevent losses, and it does not have the same size for everyone. It simply separates real-life bills from market prices. Without that layer, the investment plan can be broken by cash flow pressure rather than by long-term reasoning. This is why a funding plan cannot be only about expected return. It must include cash flow, responsibilities, and time. The ability to stay disciplined often depends on avoiding forced decisions at the worst possible moment. Asset allocation means dividing money among categories such as stocks, bonds, cash, or other asset classes. The point is not that one ratio is correct for everyone. The point is that the risk level should match goals, time horizon, income stability, and tolerance. If a 20 or 30% decline would make the plan impossible to follow, the problem may not be technical analysis. It may be risk design. A useful allocation is not the one that looks most exciting in a calm market. It is the one you can understand, acknowledge, and follow when the market is uncomfortable. Diversification can reduce dependence on one asset, one sector, or one decision, but it cannot eliminate the risk of loss or guarantee returns. That distinction matters. If diversification is misunderstood as protection from all declines, a normal drawdown can create disappointment and panic. A healthier framing is, I am not putting my entire life on one button. I am using structure so that one mistake does not decide every outcome. That is a funding plan idea, not a prediction tool. And even a diversified portfolio can decline, so the plan still needs an answer for broad market stress, not just single position stress. Rebalancing means using a pre-written rule to move a portfolio back toward its target allocation. After a large market move, weights can drift away from the original plan. The educational point of rebalancing is to bring risk back toward the intended level. It is not a promise of profit, not a way to call the bottom, and not a universal instruction to buy the dip. The rule should exist before emotions arrive: how often to review, how far weights can drift, and how taxes or transaction costs are considered. Rebalancing is closer to steering correction than to pressing the accelerator. Its purpose is to bring risk back to the level you meant to hold. Reducing risk does not have to mean predicting more downside. Sometimes the reason is that life changed. A goal date moved closer. Income became less stable. Debt or liquidity pressure increased. Family obligations changed. Or the investor realized that the original risk level was never emotionally realistic. Those are planning reasons. They're different from saying, I feel the market will fall more. If every sell-off forces a new life plan, the original plan probably needs repair. A good reason to reduce risk should still make sense before the market opens, not only after prices have already frightened you. Before taking action in a sell-off, ask 4 questions. 1. Is this money needed soon? 2. Did my life goal change, or did only the market price change? 3. Is this action written in my rule? 4. If I do nothing for 24 hours, what real-world harm actually happens? These questions do not name a stock, and they do not forecast tomorrow. Their job is to lower the emotional temperature enough for a planning decision. The pause itself is valuable because it changes the question from, what if things get worse? To, what did my rule already say? A simple funding plan can start with 3 sentences. First, when do I need this money? Second, how much decline or stress can I realistically tolerate? Third, if the market reaches a certain condition, which rule will I follow? The plan does not need to look like a professional investment policy statement. It needs to be clear enough that your future stressed self can understand it. A useful plan is executable when emotions are bad. If a rule only makes sense when you feel calm but disappears when you feel stressed, it is not yet a plan. It is only a wish. Imagine someone treats an emergency reserve, tuition needed in 2 years, and retirement money needed decades from now as one investment pile. During a sell-off, that person is afraid of paying bills, delaying a goal, and losing long-term capital all at the same time. That is not one problem. It is 3 problems tangled together. Once separated, living money is about stability and liquidity. Medium-term money is about matching risk to time. And long-term capital is about volatility tolerance and allocation rules. That separation does not guarantee returns, but it does show which life job each dollar is supposed to perform. So the real test during a market crash is not whether you can read the next line on a chart. It is whether the funding plan was written before the crash. When is the money needed? How much volatility is tolerable? What rule applies if prices fall? If the answers are vague, the best time to improve them is before the next emotional moment. This is general investor education about planning and risk management, not personalized investment advice. Your income, debts, time horizon, taxes, and risk tolerance may be different. So do your own research and consider a qualified professional when needed.